Welcome to Hibiscus Petroleum's Financial Results webcast. This webcast presents an overview of the results reported as part of our quarterly financial report for the 3-month period ended 30th September 2021 and released earlier today. This webcast has been prepared by Hibiscus Petroleum Berhad or the company solely for general information purposes and shall at all times be heard and or viewed together with the full quarterly report for the same period that has been made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs and projections about future events or matters. By listening to and or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. Our presentation today comprises 6 components. In Part 1, Lily Ling, Senior General Manager of Corporate Development, will discuss the overall oil market outlook together with updates on the group's proposed acquisition of Repsol assets and our energy transition strategy. In Part 2, Zalina Jamaluddin, the COO of Hibiscus Berhad, will provide an overview of operational performance at North Sabah, our Malaysian producing asset. Golokar Ravi, Manager Economics and Business Planning, will provide an overview of and an update on developments at Anasuria Cluster, our UK producing asset, in Part 3. In Part 4, Mark Payton, the CEO of Anasuria Hibiscus UK Limited, or AHUK, will then provide an overview of the status of the development project relating to the Marigold and Sunflower discovered oil fields located offshore in the UK continental shelf. In Part 5, Yip Chi Yong, or CY, our Chief Financial Officer, will present the highlights of the group's financial results for the first financial quarter ended 30th September 2021. Joyce Vasudevan, our Head of Corporate Finance, will then conclude our presentation with some of our key messages for this quarter in Part 6. Should you have any queries, you may contact our Investor Relations team, headed by Lily Ling, via the email address provided at the end of this presentation. I shall now hand over to Lily.
Hello, I'm Lily Ling, Senior General Manager of Corporate Development at Hibiscus Petroleum. Let me commence this presentation by providing you with a brief outlook on the oil market. At their ministerial meeting on 4th November 2021, the OPEC Plus alliance confirmed that they will be keeping to the previously announced production increase of 400,000 barrels per day for December 2021. This decision was taken despite pressure from the United States and other oil importing nations for an increase of oil production. The OPEC Plus alliance reiterated that it wished to avoid the need to implement future production cuts in the event that there are storage bills. Even though energy prices are increasing, at the ongoing COP26 summit, being attended by over 120 world leaders, significant pressure is being applied by activist groups for further reduction in the use of fossil fuels. Further pledges by various countries are directed towards limiting global heating to below 2 degrees Celsius above pre-industrial levels. As a result, over 40 countries have committed to shift away from coal, the single biggest contributor to greenhouse gas emissions. According to the International Energy Agency, or IEA, investments in oil and gas are complying with net zero due to pressure by investors, government policies and regulations, but investments in renewable and clean energy are not scaling up fast enough to close the energy gap. Thus, there are energy supply shortages. Referring to this chart by Rystad Energy, they see upside to oil demand from power generation from gas to oil switching and direct heating demand from liquefied petroleum gas. Demand is expected to persist through winter in Europe and Asia in particular. In this slide, we take a look at the macro environment of the energy industry today. As widely publicized in the media, the energy industry is heavily directed by the global macro aspirations to achieve net zero emissions by 2050. The IEA recently published their annual World Energy Outlook report ahead of COP26. In their report, one of the scenarios illustrated is the net zero emissions by 2050, which sets out what they consider a narrow but achievable pathway for the global energy sector to achieve net zero carbon dioxide emissions by 2050. According to IEA's simulation, the fossil fuels share in the energy mix is expected to drop from about 80% of total energy demand today to as low as 20% by 2050. This is despite projections that the global population is expected to grow from about 8 billion people today to about 9.7 billion people in 2050. Furthermore, factors such as electrification, energy efficiency opportunities, and behavioral changes are expected to contribute to more than twice the decline in the annual energy intensity in the next decade compared to decline rates in the last decade. Not many energy economists and analysts have the same outlook as the IEA, which is considered to be extremely optimistic. For instance, McKinsey & Company estimates dependency on fossil fuels in 2050 to be approximately 38%, whereas BP's energy outlook simulates a range of between 20 to 70%. This slide shows some of the realities resulting from the greater push towards net zero by 2050. Against a backdrop of the recent low and volatile crude oil prices, the increasing social and regulatory pressures aimed at fossil fuels has led to an underinvestment in the industry. According to news reports, several OPEC Plus members are struggling to raise their outputs to meet global demand, as demonstrated by the OPEC Plus alliance's compliance to production cuts of 116% in September 2021. Not only that, the promise of renewables also has under-delivered, such as seen in the UK and Scotland, where they have missed their targets on onshore wind and heat generated by renewables respectively. Furthermore, with greater demand for renewables, we note the ballooning cost of rare earth materials with year-on-year price increases of between 55% to 150%. The effect of a large fossil fuel supply gap combined with the under-delivery of renewables are structurally higher oil prices and increased volatility with spikes in prices of fossil fuels. This is causing a global phenomenon of switching to fuel, which will further negatively impact the environment, such as the switching from gas to coal, from gas to oil, and even to nuclear energy. Overall, an accelerated transition resulting from the climate change pressures is causing a negative impact on both the economy and the environment in the midterm. This chart shows a compilation of average Brent futures curve and oil price outlooks from various sources. The varied projections demonstrate the volatility of oil prices. Beyond the high oil prices of today, more recent outlooks such as the latest available projections by analysts as well as the Brent futures as of 26 October 2021 indicates that oil prices will be structurally higher and higher for longer. The chart shows that oil prices were not predicted to develop in this same manner before. The current strong outlook in oil prices is influenced by the tightening of supply from climate change pressures and underinvestment in the industry as well as the post-pandemic economic recovery. We are pleased to be able to report that we have a long-term energy transition strategy in place. One of our aims is to be a net zero emissions producer by 2050 and has been recently encapsulated in our mission statement. This net zero objective aligns us with the UK government's legally binding target of being a net zero carbon emitter by 2050, as well as Petronas' own aspiration to be a net zero oil and gas producer also by 2050. The delivery of our mission is underpinned by three enablers, these being, firstly, the creation of a resilient portfolio of hydrocarbon assets. This includes increasing natural gas resources and reserves in our portfolio, as gas is the cleanest of fossil fuels and will continue to have an important role in the energy transition. In Southeast Asia, where the greater part of our business is trending towards, we see gas as an increasingly important component of the energy mix for the generation of electricity, gradually replacing coal. Secondly, we are seeking and implementing ways to gradually decarbonize our upstream operations. In developing a pathway towards being a net zero carbon emitter, we understand that it's inadequate to declare a target for delivery by 2050 and then actually do very little. We need our targets to be underpinned by a realistic roadmap to get us there, and at this stage, we are currently engaging and seeking collaboration with key technology providers so that we can deliver on our commitment towards reducing our carbon footprint. In financial year 2021, we make significant progress in reducing our Scope 1 and 2 greenhouse gas emissions. Our group absolute emissions has reduced by 6%, while the group emission intensity has reduced by 18% compared to financial year 2020. Group methane emissions also fell by 42% over the same period. The reduction of methane emissions was an area of focus at COP26, with several pledges made to reduce methane emissions by 30% by 2030 against the base year of 2020. As another initiative, we are also exploring carbon capture and storage opportunities in order to achieve deep decarbonizing for our mid-life assets. Finally, we recognize that investment opportunities in technologies that may complement the decarbonization of the oil and gas sector will arise from time to time. In this regard, our board has approved our set of investment criteria, and we are on a continual lookout in a structured and disciplined manner for such niche technologies. Our investment criteria only allows us to consider opportunities that are sustainable, profitable, and adjacent to our industry while leveraging on our existing capabilities. There are other components of our energy transition strategy, but to summarize, our strategy is a long-term, continuous journey that we have committed to at the highest level of our leadership. And we are putting in place the necessary building blocks in the area of sustainability to ensure that we will be regarded as a relevant and responsible player in our business sector in the foreseeable future. On 1st June 2021, the group's wholly owned subsidiary, Peninsular Hibiscus Sdn Bhd, entered into a conditional sale and purchase agreement with Repsol for the proposed acquisition by Peninsular Hibiscus of the entire equity interest in Fortuna International Petroleum Corporation, FIPC, for a total cash consideration of $212.5 million. The proposed acquisition is transformative to the group as FIPC holds a high-quality portfolio of production sharing contracts or PSCs in Malaysia and Vietnam. Under the terms of the sale and purchase agreement, Peninsular Hibiscus also assumes Repsol's role as operator in the PSCs. It is anticipated that the transaction will be completed by the end of calendar year 2021. It is important to note, given that the effective date of the proposed acquisition is 1st January 2021, that all economic benefits and risks from that date will accrue to the group upon completion of the transaction. The proposed acquisition is subject to the following being obtained: an approval from Bank Negara Malaysia, which was obtained on 21st June 2021, subject to certain conditions imposed; an approval from the Barbados Exchange Control Authority for the sale of FIPC shares to Peninsular Hibiscus, which was obtained by Repsol on 29 June 2021. The receipt by Repsol of written waiver by each of Petronas Carigali and Petro-Vietnam Exploration and Production Corporation, PVEP, of its preemption rights or expiry of the preemption period under the relevant preemption notices issued by Repsol to Petronas Carigali and PVEP under each of the relevant joint operating agreements, which was satisfied on 9 July 2021. The regulatory approval from each of Petronas and Petro-Vietnam for the sale of the FIPC shares to Peninsular Hibiscus for the relevant PSCs, and approval to be secured at an extraordinary general meeting of the shareholders of Hibiscus Petroleum, the date of which will be announced once all remaining regulatory approvals are received. We continue to actively engage with Petronas and Petro-Vietnam to ensure that all the necessary approvals will be secured expeditiously. I'll now hand over to Zalina to provide a business overview of our Malaysian North Sabah operations.
Hi, I'm Zalina Jamaluddin and I'm the COO of Sea Hibiscus Sdn Bhd. Sea Hibiscus is the holder of a 50% participating interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or known as PSC. We are also the operator of this PSC. The remaining 50% participating interest is held by Petronas Carigali Sdn Bhd. The table on this slide shows the operational performance of the North Sabah asset over the past 4 quarters. That's from the 1st of October 2020 until the 30th of September 2021. For the current quarter ended 30th September 2021, the North Sabah production facilities recorded an average uptime of 81%. Average daily gross oil production for the current quarter stood at approximately 14,400 barrels, with an average OPEX of $19.16 per barrel. These metrics were affected by a period of reduced productions at the Button, South Furious, and South Furious 30 fields. Restrictions on the movement, quarantine requirements, manpower, and logistic constraints due to the COVID-19 situation disrupted the services provided by several of our contractors. Consequently, certain operational outages could not be addressed promptly, and such delays resulted in lower volumes delivered as compared to the previous quarter. OPEX in both the current and preceding quarters have also been impacted by the restrictions and the government standard operating procedures that have been imposed to control the COVID-19 situation. Notwithstanding the above, average uptime and daily production rates for the month of October 2021 have significantly improved, with the average uptime at 91% and the average net oil production at over 6,000 barrels per day. Furthermore, approximately 565,000 barrels of crude oil net to Sea Hibiscus were sold at an average realized price of $75 per barrel. Goloka will now take you through the details of the Anasuria cluster, which is located offshore the United Kingdom, in part 3 of this webcast.
Hello, I'm Goloka Ravi. I'm a manager in the Economics and Business Planning group of the company. I'll now take you through some updates on the Anasuria cluster. In Anasuria, the average uptime achieved for the current quarter was 69%, while the average daily net production rate was 1,904 barrels of oil equivalent per day, both metrics being improvements over the previous quarter. In the current quarter, approximately 192,000 barrels of crude oil net to AHUK were lifted and sold at an average realized oil price of $76.31 per barrel. We achieved an average OPEX per barrel of oil equivalent in Anasuria for the current quarter of $27.94. This was above our target unit production cost, as operational performance for the current quarter was affected by the unavailability of a critical component of the subsea infrastructure, which malfunctioned in May 2021. This component has been isolated from the primary production system. The impact of this temporary isolation is a lower overall daily production rate from the Anasuria asset, which will continue until the failed component is replaced. Engineering and procurement activities are currently ongoing on a fast-track basis, with execution targeted for the third quarter of calendar year 2022 or earlier. Until the failed component is returned to service, we anticipate that there will be an impact on calendar year 2022 offtake volumes and OPEX per barrel of oil equivalent. We will provide some guidance on the production impact once the project schedule for rectification works has been finalized. In terms of CapEx, AHUK incurred approximately 5.8 million ringgit in the current quarter, primarily for the upgrade and replacement of facilities on the Anasuria FPSO. We have been investigating opportunities to extend the economic life, unlock value, and maximize recovery from stranded oil discoveries around the Anasuria FPSO. As part of the UK's 32nd offshore licensing round, launched by the Oil and Gas Authority in July 2019, we were offered the award of licenses neighbouring the Anasuria cluster. A license agreement was executed for a 70% interest in the license P2535 Block 2124D, which contains the Teal West discovery. A further license agreement was executed for a 19.3% interest in license P2532 Blocks 2119C and 2120C, which are contiguous to the Cook Field. The Teal West discovery will be a key focus area as a potential tieback candidate to the Anasuria FPSO in the near term. Based on a report by RPS Energy, Teal West contains approximately 4 million barrels of oil net to AHUK. The base development plan for the Teal West field is to drill an oil well to the southeast of the structure, followed by a water injector well at the west of the structure to be drilled about 12 to 18 months later. The Teal West field is planned to be produced to the Anasuria FPSO about 4 kilometers away, where the fluids will be processed and exported via the Anasuria infrastructure. On the commercial aspects of the Anasuria FPSO tieback, the heads of agreement for a transportation, processing and operating service agreement, or TAPOSA, was executed between Anasuria Operating Company Limited and AHUK on 4th August 2021. Advanced discussions are also ongoing with the gas pipeline owners to extend the current AHUK gas sales agreement for the Anasuria cluster to include the Teal West gas production. The Teal West Concept Select Report was submitted to the OGA on 10 September 2021. The Teal West field is planned to be developed on an accelerated schedule with the following future milestones: field development plan submission to the OGA, drilling of oil development well, subsea pipelines installation, and Teal West first oil. We are pleased to report that in the United Kingdom, the Royal Society for the Prevention of Accidents recognized the team at the Anasuria FPSO with the following awards: the Gold Award for calendar year 2020 Health and Safety Performance for the 22nd consecutive year, and the Order of Distinction for 22 consecutive annual Gold Awards. We also achieved 7 years without a lost time incident on the Anasuria FPSO on 6 October 2021. Our primary goal remains that of continuously providing a safe and secure workplace for all our employees, and we are extremely pleased to have been recognized once again by these respected institutions. I will now hand over to Mark, who will give you an update on the Marigold and Sunflower assets.
Hello, I'm Mark Payton. I'm the CEO of Anasuria Hibiscus UK Limited, or AHUK. I will now briefly take you through the key points of our interests in licence P198, blocks 1513A and 1513B, which contain the Marigold and Sunflower discovered fields respectively. These are development assets which are located in the United Kingdom. This slide shows the target timeline for the development of the Marigold and Sunflower fields as we achieve key milestones towards our first oil objective from these assets. We purchased interests in the blocks in which these fields are located, and based on reports from third-party competent experts, they contain 43.6 million barrels of 2C contingent resources net to the group, based on AHUK's 87.5% interest. In January 2021, the Oil and Gas Authority of the UK, or the OGA, requested that AHUK work with Ithaca Energy Limited to propose a common development solution for the resources found in P198 Marigold and P2158 owned by Ithaca. P2158 is immediately to the south of Marigold and contains the Yeoman discovery, now called Marigold East. AHUK has concluded its technical and commercial work related to the use of an FPSO as a development solution and has submitted our findings to the OGA. Ithaca has continued to pursue an alternative development solution which examines the technical and commercial viability of a tieback of the combined resources to the Repsol Sinopec Piper B platform, which is located in close proximity. Schematics of both development concepts are shown here. The OGA has indicated that it will allow Ithaca until the end of calendar year 2021 to finalise its tieback proposal. At that point, it is expected that the OGA, Ithaca and AHUK will decide on the next steps to be pursued. It is highlighted that AHUK development solution is predicated on the use of a specific FPSO, and our exclusivity over the use of this FPSO for the Marigold cluster expired at the end of September 2021. Anasuria Hibiscus UK is working with the owner of the FPSO, Altera Infrastructure, to try and retain the FPSO option. I will now pass you on to CY, who will take you through the financials of the group for the current quarter.
Hi, I'm CY, the group's Chief Financial Officer. I'll now take you through the financial highlights for the current quarter. The group's financial performance and profitability in the current quarter was strong on the back of relatively high oil prices. During the current quarter, earnings before interest, taxes, depreciation, and amortization, or EBITDA, attained was 123.6 million ringgit. The resulting EBITDA margin over revenue was 50%. The group's profit after taxation in the current quarter was 41.5 million ringgit, or 17% margin over revenue. During the current quarter, the group sold approximately 757,000 barrels of crude oil from North Sabah and the Anasuria cluster. From North Sabah, 565,000 barrels of crude oil net to C Hibiscus were sold, while 192,000 barrels of crude oil were sold from the Anasuria cluster. The average realized oil price per barrel achieved for the offtakes in both assets during the current quarter was higher compared to that of the previous quarter. For the North Sabah offtake, $75 per barrel was achieved in the current quarter compared to $72.07 per barrel secured in the previous quarter. In addition to that, the average realized oil price per barrel recorded in the Anasuria cluster of $76.31 per barrel in the current quarter was $13.64 higher than that secured in the previous quarter of $62.67 per barrel. Revenue generated by C Hibiscus in the current quarter was reasonably consistent to that recorded in the previous quarter. Even though a higher average oil price was realized, revenue was lower due to the lower volume of crude oil sold. C Hibiscus sold 565,000 barrels of crude oil as compared to 608,000 barrels in the previous quarter. Average OPEX per barrel in the current quarter of $19.16 was higher compared to the previous quarter's $15.67. This was mainly due to the lower production in the current quarter on the back of higher OPEX from plant maintenance activities. In addition, average net oil production decreased from 6,394 barrels per day in the previous quarter to 5,311 barrels per day in the current quarter, while average uptime in the North Sabah production facilities in the current quarter fell to 81% from 95% in the previous quarter. This was due to a period of reduced production at the Barton, Sulphurous, and Sulphurous 30 fields during the current quarter, which was caused by certain restrictions on movement, quarantine requirements, manpower and logistic constraints during the COVID-19 outbreak. The services provided by several of our contractors were disrupted, and as a result, certain routine operational outages could not be addressed promptly. The resulting gross profit margin over revenue in the current quarter of 65.8% was therefore lower compared to the previous quarter's 70.7%. The North Sabah asset reported EBITDA of approximately 102 million ringgit in the current quarter compared to approximately 106 million ringgit in the previous quarter. EBITDA margin over revenue of 57.4% was a slight reduction from the 58.8% recorded in the previous quarter. Despite the adverse operational performance in the current quarter, when compared to the previous quarter, the current quarter's profit after taxation was higher than the previous quarter's profit after taxation by 1.6 million ringgit. The lower production levels in the current quarter resulted in lower amortization of intangible assets and depreciation of oil and gas assets of 3.4 million ringgit compared to the previous quarter. In addition, administrative expenses reduced by 6.6 million ringgit in the current quarter, mainly due to lower development OPEX incurred. Highlighting the tax-related items, the tax regime under which Malaysian oil and gas activities are governed and is thus applicable to C. Hibiscus is the Petroleum Income Tax Act 1967 or PITA. The provisions of PITA are applied to net taxable petroleum income at the rate of 38%. The effective tax rate in the current quarter of 38.3% was consistent with the PITA rate. Turning to the Anasuria Hibiscus segment in the United Kingdom, revenue recorded in the current quarter amounted to 67.4 million ringgit, which was slightly lower than the previous quarter's 70.4 million ringgit. In the current quarter, 192,000 barrels of crude oil net to AHUK were sold at an average realized oil price of $76.31 per barrel, compared to 255,000 barrels sold at $62.67 per barrel in the previous quarter. The gross profit margin of 57.8% was fairly consistent when compared to the 59.6% attained in the previous quarter. Average uptime and average OPEX per BOE achieved in the current quarter of 69% and $27.94 respectively reflected a more favorable operational performance when compared to the previous quarter. In the previous quarter, average uptime was 53%, while average OPEX per BOE was $38.22. In the previous quarter, the Anasuria asset completed the planned 2021 offshore turnaround between April 2021 and May 2021, when the FPSO facilities were completely shut down. As a result, average daily oil production rate in the current quarter was higher by approximately 34%, from 1,642 barrels per day in the previous quarter to 2,206 barrels per day in the current quarter. Both EBITDA and EBITDA margin over revenue in the current quarter of 35 million ringgit and 52.1% respectively were higher compared to the previous quarter's EBITDA of 30 million ringgit and EBITDA margin over revenue of 42%. As far as the UK fiscal regime is concerned, in the United Kingdom, the total tax rate for Anasuria Hibiscus is 40%, which consists of a ring-fence corporation tax and a supplementary charge at 30% and 10% respectively. AHUK posted a profit before taxation for the current quarter of 18.6 million ringgit and provided for taxation liabilities amounting to 6.5 million ringgit. Our business performance is underpinned by several factors, predominantly the price of the Brent crude oil benchmark at approximately the time of a scheduled offtake
from our crude oil storage facilities, given that the oil price is affected by global macroeconomic factors which are not within the control of the company. Focus is placed on the operational performance of the assets, such as production rates and facilities availability, as well as the management of operational expenses. A key metric that we utilize to track our operational performance is average unit production costs. The careful management of costs and the efficient delivery of production enhancement projects are important elements of our strategy of maintaining a low unit production cost structure in both the North Sabah and Anasuria assets. This is a significant contributor towards our profitability. Throughout calendar year 2020 and the early months of calendar year 2021, the group activated various plans to mitigate the effects of unstable oil prices. Some of these measures involved the deferral of non-safety critical OPEX-related activities. With the trend of increasing crude oil prices currently being observed, and to ensure long-term asset integrity and safe conduct of operations, some of the activities deferred in calendar year 2020 are being gradually reinstated into our current and future work programs to ensure smooth and safe operations. We wish to reiterate that whilst profits are extremely important, management's focus remains on delivering strong and sustainable EBITDA levels, as long-term business continuity is of the highest priority. Year on year, both total assets and shareholders' funds have grown by 388.1 million ringgit and 332.7 million ringgit respectively. Shareholders' funds of about 1.5 billion ringgit include retained earnings of 493.4 million ringgit. Net assets per share currently stands at 76 cents. The group's net current assets position as at 30th September 2021 is strong, at 226.9 million ringgit. In addition, as of 30th September 2021, the group's unrestricted cash balance stood at 204 million ringgit. The restricted cash recorded in our results relates mainly to a security for our portion of the estimated cost of decommissioning the facilities of the Anasuria cluster. In this regard, we are required to periodically place monies into a trust, and this commenced 18 months after the completion date of the Anasuria cluster acquisition. This activity will continue until such time that the security has been fully provided. In November 2020, we announced the successful raising of 203.6 million ringgit through the placement of Islamic CRPS. These funds will be used for the potential acquisitions of producing assets in Southeast Asia. In June 2021, 61.8 million ringgit of this amount raised was utilized to pay for the deposit for the proposed acquisition of Repsol's oil and gas assets located offshore Malaysia and Vietnam. Total debt balances as at 30th September 2021, 30th June 2021, 31st March 2021 and also 31st December 2020 relate to the recognition of the liability component of the CRPS upon the issuance of the first two tranches in November 2020. As at 30th September 2021, about 99% of the total CRPS issued has been converted into ordinary shares of Hibiscus Petroleum Berhad. This explains the sharp reduction in the debt balance seen on our balance sheet from 128.6 million ringgit as at 31st December 2020 to only 2.7 million ringgit as at 30th September 2021. The high CRPS conversion rate has also resulted in the total ordinary shares of Hibiscus Petroleum Berhad increasing from 1.72 billion as at 31st December 2020 to 2.01 billion as at 30th September 2021. Net assets per share as at 30th September 2021 stood at 76 cents per share, which is fairly consistent with the 75 cents per share as at 30th September 2020, despite the significant increase in issued ordinary shares. Before we wrap up, I would like to hand over to Joyce to highlight a few takeaway points.
Hello, I am Joyce Vasudevan, Head Corporate Finance at Hibiscus Petroleum. I would like to close this presentation with some key messages. A final dividend of 1 cent per share was recommended by the board to be paid on 28th January 2022 with an entitlement date of 4th January 2022. our subsidiary C Hibiscus signed an amendment and restatement agreement with Trafigura in respect of a prepayment agreement of up to $80 million, which extends the existing facility to 31st December 2023. This facility may be utilized to fund general working capital requirements, capital expenditure, and general corporate purposes. Since the previous update, oil prices have reached levels not seen in 3 years, in part due to the current spike in oil demand, as more countries ease restrictions and the Northern Hemisphere enters winter, with supply not following suit as OPEC Plus strictly adheres to its production cut tapering. These higher oil prices have positively impacted the group's financial performance. In the current quarter, we sold 757,000 barrels of oil, and we expect to deliver approximately 2.5 to 2.7 million barrels of oil for financial year 2022 from North Sabah and Anasuria. In the event that the proposed Repsol acquisition is completed by the end of calendar year 2021, we expect to add a further estimated 3 million BOE of oil and gas to the 2022 financial year results. Subject to the completion of the proposed Repsol acquisition, we anticipate the scale and profile of the group to be substantially positively impacted, providing us with an even stronger platform to pursue future growth opportunities. Post-acquisition, we expect our oil, gas and condensate production to almost triple to 26,800 BOE per day, with our 2P reserves increasing by over 1.5 times. As a responsible energy company, we have enacted our energy transition strategy, which will contribute to the relevant United Nations Sustainable Development Goals. In order to mitigate climate change, we are committed to our energy transition strategy, in which we have aspired to be a net zero emissions producer by 2050. In financial year 2021, we have made significant progress in reducing our Scope 1 and 2 greenhouse gas emissions. Overall, we recognize that macro conditions are volatile, with uncertainties caused by the continuing COVID-19 pandemic, but we remain focused on delivering optimal performance in an improving oil price environment. Back to you, Andrew.
And that's all we have for this quarterly earnings webcast. Thank you for tuning in.